Welcome to the Ellsworth Advisors monthly update for April 2022. I'm Kelly Keenan, this is Cameron Mealy, and today we're going to discuss the latest economic news, market news, also talk about how our portfolios have performed year to date and really what our expectations are moving forward. So Cameron, why don't you kick us off with a little economic update?
Thank you, Kelly. Good morning, everybody. Not surprisingly, Kelly, the biggest news we're hearing this week is the Fed did meet May 3rd and 4th, and yesterday, May 4th, the Fed announced that they're raising their key interest rate by 50 basis points. Jerome Powell, the Fed chairman, had his usual speech that he gives, an question and answer session after. Biggest takeaway, I think, was 50 basis points was not a surprise. It was the expectation. We saw the market have a huge relief rally after the announcement. Dow was up approximately 900 points, which is about 2.5%. So all of this is in line with expectations, but the message that continued to come out and was very interesting was that fundamentally the Fed believes the economy is very strong. Employment's low, the economy's doing well, companies' balance sheets look strong, profitability, earnings look good. The biggest issue is this inflation issue, primarily driven by a lot of easy money policy during the pandemic, driven by a lot of supply chain constraints, and it's a global issue. So if you look at 50 basis points, it was in line with expectations. If you talk to economists, a lot of people believe that this is really just the first step. We had 25 basis points early in the year. We have 50 basis points now. There's a lot of expectations. We could see another 200 basis points.
The expectations are the next couple hikes will be at that 0.5%, that 50 basis point level. Obviously, we had a lot of volatility in the last week coming into the announcement. There were some fears out there that the Fed would get even more aggressive and go 75 basis points. And layer that on top of a really weak Q1 GDP number. A lot of people come out are thinking maybe we'll see recession sooner.
Yep.
Like we're going to have a recession this year, or first quarter was the beginning of a recession. The jury is definitely still out.
Well, it's interesting. You touched on GDP. So on Thursday, April 28th, the Bureau of Economic Analysis released their advanced estimate of first quarter GDP. And they showed GDP declining at annualized rate of 1.4% in the first quarter. If you remember the fourth quarter of 2021, GDP increased at 6.9%. So a dramatic swing. The consensus estimate on Wall Street, according to CNBC, was a negative 1.5% to a 1.1% increase. So obviously negative 1.4% decrease was on the low side of the consensus estimate. What was interesting is Fed Chairman Powell, again, discussed how strong he felt the economy was and really felt like the first quarter GDP, while it was weak, it was really the result of reduction in inventories and reduction in exports. So fundamentally, nothing within the U.S. economy he felt was weak. It's just two of the numbers that make up major contributors to that. Inventories and exports were down significantly. Most of that because of, again, global supply chain issues.
Right. We're definitely in a new regime, new scenario with higher inflation, rising interest rates. I don't think either of those trends are going to continue, with the caveat of inflation isn't going to get higher than where it's at today. We're probably around peak inflation if we haven't seen peak inflation. But that doesn't mean by the end of the year we're still not sitting at a 4, 5, 6% inflation run. So, we're going to be higher inflation than what we've been used to the last 12 years of 1 to 2% inflation. We have to kind of assume that we're in a higher inflation regime for the foreseeable future, meaning years out where we could be at 3, 4% inflation, which is a little different environment than what we've had. That changes the investment landscape a little bit. And, once again, with what happened with the reopening of the economy, those numbers, they're not uniform across the economy. Yeah. So some areas are stronger than others. And we have to expect the volatility to continue. So we got a relief rally yesterday. I think the markets, we have to kind of, I'm thinking we're going to see some strength here, but is this like the V recovery you saw through the pandemic? No, this is definitely going to be a long,
choppy recovery.
This is going to be a longer process. There's still a lot of weeding out that has to be done, and if what we saw first quarter was not the beginning of a recession. And we end up not really seeing recession in 22, which is kind of what I've thought for a while now, that there's enough reopening activity, enough strength, enough cash. Consumers have healthy balance sheets. Corporations, for the most part, have healthy balance sheets to at least drive us through this year without a recession, where recession is still probably 23, 24 event, most likely a 23 event, if it's not happening now. So it's going to be a choppy ride, and we have to be real careful of where we're putting our money.
Well, and I guess the inflation concern is one of the biggest issues that can push us into a recession. I mean, if you look, these numbers are a little bit dated, but this is according to the Bureau of Economic Analysis. This is the March 2022 Producer Price Index, year-over-year increase from March 2021. The increase over the last 12 months was 11.2% for producer prices. So, I mean, think about a consumer that's getting a cost of living, an hourly wage person, someone who's getting a cost of living adjustment at 2-3%. They're now seeing their grocery bills, their fuel bills, their everything up by 11%. I mean, that's cutting into real earnings.
It's not keeping pace. Absolutely.
Yeah, and that's going to dampen consumer demand. That's going to demand, consumerism, which we've seen a lot over the pandemic. And if you look at that measure, the producer price index of inflation, it's broad-based. So the increases were across all sectors, with goods increasing by 15.7% year over year, prices for services increasing 8.7% year over year, and prices for construction increasing 16.7%.
Absolutely.
None of those numbers, if you've gone to the grocery store, if you filled up your gas, if you tried to get a quote on a bathroom remodel, none of these numbers should surprise you, but they are numbers we've not seen in my lifetime, not seen in your lifetime.
And, well, in my lifetime, yes. I'm a little older than you. But
you were 3 at the time, so.
The reality is that wage piece, I think you're going to continue to see pressure on wages. Labor now, I think, holds and is going to hold a little bit more power and sway in this next environment than what it has the last 12 years. That will kind of put a permanent pressure on the inflation piece. The supply chain stuff ultimately will work itself out. Yep. So that's something, that piece will go away, which will reduce our inflation rate off the 8 point whatever rate we're at right now. But I think that wage piece will continue to grow, and that's something we need to keep into consideration when we're looking at investments, is who can handle those increases. Is our economy strong enough to handle those increases? Absolutely. Will there be some damage along the way? Absolutely. But ultimately, yeah, we're going to get through this. We've gotten through in the past. This, I don't think, will be as bad as the 70s, 80s scenario. But there's going to be some similarities to what we saw back then.
And to your point about, this is the last number, your point about labor having more power is, according to the Bureau of Labor Statistics, the number of job openings right now, this is on the last day of March, stands at 11.5 million. That's a number we've been between 10 and 11.5 million for the last 18, 19 months. This is the highest level of job openings since they began tracking the statistic in 2000. Obviously, that can be a little misleading because the population has grown significantly since 2000, so job openings should naturally, but I mean, you think about 11.5 million jobs out there. And yes, that gives labor, a real key to demand more flexibility, to demand higher wages. And, those higher wages are going to get pushed onto the consumer.
Right.
Eventually it happens.
No, it was going to happen at some point. 15, 20 years ago, we started offshore, and a lot of our labor went to Asia, where it was really cheap. Labor has increased, internationally. So now, things are kind of coming home to roost, where, a lot of these jobs are ones that have been offshore. Now they're coming back to the United States, and, our labor force has to adjust because nobody's been trained to do these jobs or wants to do some of these jobs. And the reality is those are where the jobs are.
Yep.
And just the wages will have to come up to, commensurate to, make it worthwhile.
To
make it worthwhile to do that type of work. So that's kind of where we're at. Let's talk about our portfolios a little bit. April was a brutal month. On the stock market side, which we usually focus on, but also on the bond side. So you put, both stocks and bonds having one of the worst months in 20 years. Okay, yeah, you see a lot of pain to a lot of traditional portfolios. I think our positioning has been pretty good to minimize that damage. In April, the Dow Jones was down 6.6% just for the month, leaving the year-to-date number through April 8.73. So the Dow has been the winner this year just because of the more conservative nature of the stocks inside the Dow. The S&P 500 for the month down 10.8%. So I think that was maybe surpassed what happened in March of 2020, early pandemic. Year to date, that puts the S&P at negative 12.92%, so down about 13%. You know, they've a little bit lower since last week, even with, you know, it's been big ups, big down. So that's about where we're at today. The NASDAQ, which really focuses more on technology stocks, more your high multiple type stocks that are a little bit more speculative.
Future earnings.
Future
stats.
Earnings. NASDAQ for the month down 15.63. Year to date down 21%, so officially in a bear market. Some people are expecting at least a bear in the S&P, so that means there could be more room on the downside with the S&P. Internationally, international stocks actually, you know, for the month, once again, down 7.63. Year to date, down 12%. So international no longer leading the downside, which, you know, much of last year that was the case, and they were the big laggards last year. Not quite as bad anymore. On the emerging market side, down 5.3 for the month. Year to date, emerging markets down 12.15. So it's been kind of across the board in the stock world, in the bond world, because bonds perform differently based on how long their maturities are. So your longer dated bonds or your bond funds that have longer dated bonds within them, you know, many of those, like the Barclays Ag is down between 8 and 10% year to date. So almost in line with what's going on in the stock market. Real short-term bonds down a couple percent. Mm-hmm. And, you know, kind of where we focused our bond holdings or our fixed income holdings, they're slightly negative, down, you know, anywhere from 0 to 1%. So they're kind of hanging in there. From a portfolio standpoint, dividend yield for the month was down 4.25%, so that hung in there pretty well. Year to date, it's down 5.4, so, you know, about half of what the S&P is. There were some stocks that made money last month. Merck up 8%. Fortunately, we hold in a couple portfolios, so that helped us out. Coca-Cola up 4.21. Waste Management up 3.75. LyondellBasell, which is a chemical company, up 3%. So kind of boring companies that make stuff, do stuff that people always use.
And make money.
And make money with good balance sheets. Okay, yeah. They made money last month. The laggards, Blackstone, which in this portfolio, we made a lot of money in Blackstone. We actually cut our exposure earlier this year. Blackstone's given some up, down 20%, UPS down 16%, Intel down 12%, Cisco down 11.5%. For the year, Merck is a big winner in this portfolio, up 16.75. Once again, the LyondellBasell up 16%. British American Tobacco up 13.6. Coke up 10. Edison up 9.75. Southern Co, another utility, up 8%. So once again, the boring stuff's working. Big laggers, once again, Cisco's down 21%. Blackstone down a little bit over 20. Pfizer, you know, opposite of Merck, Pfizer down 20%. And that could be a case of it went up because of the pandemic and now it's kind of giving a little bit back, kind of righting itself. 3M down 18%, Eaton down 15%. Growth with income portfolio. Once again, down 4.15%. And this is a portfolio that's only about 55-60% stocks.
You'd call it a balanced portfolio.
It's kind of a balanced portfolio, but because of where we're at in bonds and the fact we have commodities, it's held up really well versus a traditional just stocks and bond portfolio. Year to date, down 4.75. Big gainers for the month, Nucor up 4%, our commodity portfolio up 4%, Exxon up 3.2%. Digital Realty up 3%, Pepsi up 2.6. Laggards, Nvidia, once again, another stock that we made a lot of money in. We really cut that position early in the year. So even though it's down 32%, we've kept a lot of our gains because we sold out of it. Disney still feeling some pain, down 18.6. Starbucks down 18. Microchip Technologies down 13. Apple down 9.7. For the year, Nucor's a big winner, up 36%. Our commodity fund up 29%. Exxon up 18%. Since we bought it, Exxon itself is up 40, so we haven't rode that whole wave up. What we did was, it's early in the year, we kind of took the proceeds from NVIDIA and bought Exxon with it. Berkshire Hathaway hanging in there well, up 8%, and J&J up 6%. Big laggers once again. NVIDIA down 37%. Lennar's given up some ground on the home builder side, down 33. Disney, down 28. Nike down 25. Microchip down 24. Price Potential, which is more of our growth portfolio, April hung in there really well, only down 4%. Year to date, we're down about 7%, so closer to what the Dow has done. But for a growth portfolio, pretty happy with what's happening in there. What worked last month, Asbury Auto, basically a used car dealer or a car dealer, up 14%. Black Knight up 13.5, Merck up 8 again, Humana up 2. Big laggers, T. Rowe Price took it on the chin at down 18.6. Google down 17.7. Comcast down 14.6. Stryker down 9.8. Year to date, Merck once again big winner, up 16.75. FleetCor Technologies up 11.5 year to date. Asbury Auto up about 6.4. Year to date, laggards, Facebook, we felt pain there, but it seems like we've seen the valley on there, and it's definitely been kind of refinding its footing. And Facebook, of the technology stocks, we bought it after it had already been down because the valuations were looking much more attractive. And even now, obviously it's gone down more, but it's starting to recover because its valuation is pretty good. And you may disagree with some of the political stuff they do, but from a business standpoint, it's actually looking pretty attractive. So we're kind of hanging on.
Of all the social media platforms, they definitely do have the best business model in terms of converting eyes on the site into dollars.
And the valuations make sense. I mean, they're like, this is not an overvalued stock at this point in time. Microsoft down 17% in the price potential. Our small caps, once again, the most volatile. For the month, down 3.8, which in a volatile month, you would have expected that to be our biggest laggard. It actually hung in there really well. Year to date, down 13.8 compared to the Russell 2000, which is down 16.7. So once again, small cap stocks are always the most volatile. Year to date, we're down more than 10%, which isn't great. But for the month, the fact that it held up well, that gives me some encouragement. Big gainers, Sierra Oncology, this is just for the month, up 70%. Lantheus Holdings up 20%. Alpha Metallurgical, they're basically coal for making metal or making iron, obviously with the issues going on in Eastern Europe where a lot of that's done.
Yep.
That's going to bring some business back to the U.S., up 17%. Northeast Bank up about 17%. The big laggards, which these are big numbers too, not huge numbers, but on the downside, Kaiser Life Sciences down 28%, Renpac down 26%, Stewart Information Services down 14.9%. So I would have expected some bigger downside, but that was good. I mean, that's why we were only down 3% Year to date, Sierra Oncology still leading the group, up 150% year to date. Lantheus up 129 year to date. Anderson's, which is more of a agricultural retailer, up 30%, still pretty good. Esquire Financial up 14%. Big year-to-date losers: Clearfield down 31%, Advanced Drainage down 25%. Advanced Drainage, that's one where we're probably the life of our holding up, I think 250, 300% in there. So that's been a good holding. Just gave a little bit back there. Nova Measuring up down 32.7%. So, it's going to be a rough ride. It's kind of, hang in there. The big thing, and we've always talked about, is managing our liquidity so that we have plenty of cash for distributions, needs, and really when we see these kind of reprieves in the market, these little bounces up, which, we probably have a little bit of a rally in front of us. Is it the end-all rally back to the all-time highs? I
probably
seriously doubt it. But this is, kind of the time where either we're dipping into, or no, not dipping in, we're actually, pulling dollars back to provide more liquidity, reassessing when we get some relief to the upside, so that we can ride through the bumps along the road.
And please remember, the best planning that we can do is by knowing what's going on in your situation. So as things change, let us know. Constant communication, early communication. Even if we're thinking about bidding on a house. We don't have it under contract yet. We don't know about the financing. Let us know so we can start planning. We can provide any advice possible. We have to have open lines of communication to make this a successful partnership.
Absolutely. Thank you. Have a great month.
We'll talk to you again. If you have any questions, please feel free to reach out to us.